What are the tax consequences to the shareholders? We walk through that. How does Ben's death otherwise impact the S corporation? Does it change the S corporation's eligibility?
It may if you had a non-citizen spouse.
That's true. That's a good point. So if, as a result of this, Ben, who they had a separate property agreement, and as a result of his estate plan, everything transferred to his non-resident alien spouse, then we have a problem. That's a very good point. But assuming that his spouse is not a non-resident alien, I think we're going to be okay. The fact that Ben died is not going to cause the S corporation to cease to qualify. The estate of a decedent is a qualified shareholder. So we're okay there. All right. Now, this was the one you guys turned in, right? So let's walk through this. So A owns 100% of the stock of Corporation X, an S corporation. The corporation was formed January 1, 2003 and is operated as follows. Okay. 1103, A forms Corporation X, contributing real property with a basis of $25,000 and a fair market value of $45,000 for all the stock. Okay, is that a recognition event? Do we have any gain or loss recognized there? No. What is A's initial basis in the S corporate stock? Anybody? Should be 25, right? Right. Just standard corporate rules apply in this case. So it is 357 or 361. No, not 357. It's either 358 or 361. One's inside, one's outside. But the S corporation will take the property with a basis of $25,000, and A will take the stock with a basis of $25,000. Same as the partnership rules. Okay. 2003, Corp X loses $40,000. A has made no further capital contributions or loans. Corporation X has made no distributions to A. Corporation X has borrowed against the property to finance the losses. The point of that is just to let you know, I mean, if you put in a property worth $40,000, how do you manage to lose, or worth 45? How do you manage to lose 40? It's pretty impressive to lose money that fast. Be that as it may, I mean, there must be some reason for this, but there were borrowings, and the borrowings funded losses. So let's take a step back and say, all right, so we had an initial basis of $25,000. Now we've got $40,000 of losses. What happens?
Did we not have to hand in the first two problems?
No, you didn't. You only had to hand in this one. But I appreciate the effort. So the $40,000 is going to be allocated to the shareholder, right? Can the shareholder take advantage of the $40,000 loss? No, not all of it. Yes, just $25,000 of it, right? What happens to the other 15? Suspended, just like the partnership rule. Suspended carries forward until you have basis. Okay. 2004, A loans the corp $20,000, taking back a note. Corporation X breaks even for the year. Okay, what does that mean? What happens there?
Debt basis.
Debt basis, thank you. What does debt basis allow us to do? Take losses. But we don't have any losses for the year, right? Suspended loss, yes. Yes, so we're able to take that $15,000 loss. So we started with $25,000 of basis, and we backed out $25,000, and we suspended $15,000. That's all 2003. Now in 2004, we add 20,000 debt basis, and then we take that 15,000 against it, right? So the suspended loss is taken. So that's 2004. And so we should have a basis now of 5,000, that's right. In the debt, yes, whoever said that, that's right. 5,000 in the debt, 0 in the stock. Okay? 2005, Corporation X pays $10,000 on the note to A. Corporation X breaks even for the year. Okay. How do we treat that? We've got a partial repayment of the notes. Do I have any gain recognition on that note?
There's a ratio.
It is a ratio, absolutely. What percentage of the debt was repaid?
I looked it up at the time.
Well,
I needed the
in this case, we paid back half the debt, right? It was initially a $20,000 debt, and $10,000 of it was paid back. So how much of our $5,000 of basis can we recover? $2,500, half of it, right? It's the same ratio. So we've got a $10,000 payment on the debt, and we recover $2,500 of basis. $7,500. Is that gain or is that ordinary income? Gain, why? It's capital, and why is it capital? There's a note, yes, there's a note. There's a note, so it's capital. If there was no note, it would be what they call open account debt. That's ordinary. Okay? There was a slide on this, but I moved quickly to try to confuse you all. It almost worked, you caught me. So the fact that there's a note means that this is capital in nature, assuming you're not a dealer in such notes, right? If you're a dealer in these notes, it'd be ordinary, but let's assume you're not. So we got $7,500 of gain. How much basis do we have in the stock?
0.
0. How much basis do we have in the note? $2,500 in the remaining $10,000 of debt that's outstanding, right? Because we recovered $2,500 of our basis. We have $2,500 left. Now, 2006, Corporation X loses $10,000. Well, we said we have 0 stock basis. We have $2,500 of debt basis. We're going to take $2,500 of the loss. And we're going to suspend $7,500 of the loss. It's just going to carry forward. And then finally, in 2007, A sells all her Corporation X stock to B for $60,000. So that sale of the stock, what's the gain or loss on that? What's our basis in the stock? 0. All right, so we have 0 basis in the stock. We sell for $60,000. We should have $60,000 of gain, right? Should be capital. Looks like it's long term. What happens to the debt? Is it still outstanding?
Forgiven.
Well, based on, after this, for 2007, A sells the stock, but the debt's still there. There's still a $10,000 debt outstanding. So the S Corporation owes $10,000 to A, but remember, A has no basis in that. So when the S Corporation gets around to paying it back, A will be recognizing gain on it. Okay?
And the 10 grand loss in 2006, is there a suspended loss of 7.5?
There is a suspended loss. Are you able to take that when you sell the stock? No, you're not. That's correct. Think about it. It's a circular thing. If you were able to take it, your basis would go down. You have no basis to go down. But let's say you treat yourself as though you have basis. You take the loss and then increase your gain. They'd offset. So because that $7,500 loss never impacted your basis, it doesn't change anything for you. You just sell your stock. But B steps into your shoes. That stock has a $7,500 loss associated with it, and B can now take that loss. because B has $60,000 of basis in the stock. So notice that little twist there. That basis, or that suspended loss, isn't taxpayer specific, it's specific to that stock. So it will carry forward. Okay? And that is how that question works.
And
Questions?
2,500 came from half of the 5,000?
Half of the base that was remaining in the debt, yes, half
Half.
of 5,000, yes. Exactly.
And upon selling the stock, she has gained, or A has gained.
A has a gain. By selling the stock, A is going to have a gain just on the sale of stock. $60,000 in proceeds, zero basis, $60,000 of gain.
And there was $7,500 of ordinary income previously realized.
No, there was $7,500 of losses that were suspended.
Okay.
Doesn't look like A did a very good job at this business.
But there's gain on the payment of the note, though.
Well, when the note is repaid, when the note is partially repaid here, there is gain. The rest of the note is never satisfied.
Right. So what's
So yeah, it
there's
carries
still,
forward.
there's still 7.5.
You're right. There was $7,500 of capital gain on the partial
Right.
repayment of the note.
Okay.
Yes.
Okay.
That make sense? Good example of the sort of thing you want to understand. Okay? You want to know how these rules work. This is good for the basis rules, allocations. I mean, it's simplified allocations because there's only one shareholder, but okay, distributions. Okay, Corporation X is formed on January 1, 2006 and elects to be taxed as an X corporation for its first year. A owns 100% of Corporation X's stock, which she acquired on formation with a $5,000 cash contribution. Assume the following. We've got 2006 and 2007 results. We've got income from operations, we've got tax exempt interest income, and we have distributions.